For having me. So the sell-off started about a week and a half ago, but then it started to escalate down lower in the middle of this week. That was triggered by several things. So first of all, the hawkish Bank of Japan caused an implosion of the carry trade over a short-term basis. We also had bad U.S. manufacturing data out of the U.S. and some employment sub-indicators which scared markets. And then overnight, we saw a lot of volatility in some of the major earnings. And all of that helped push equity markets, which had been quite expensive, even lower. But one thing that people aren't remembering is that usually between the period of July and October, there's seasonal rise in volatility for equity markets. So this isn't to be completely unexpected given the historical patterns around calendar effects on equity markets, especially after the fact that there was such a large rally in US stocks and global stocks, the fact that earnings came in a bit kind of mixed and valuations are high, but also monetary policy remains very tight.
The stock market is, to put it delicately, a fickle beast. One moment it showers companies like Nvidia and Meta Platforms with an abundance of investor affection. The next, it seems to predicate doom, with industry giants fending off worries of overpriced shares. In a week where Wall Street finally evaded a 3-day slump with a broad-based rally, claws were still out for Nvidia's AI promises and Microsoft's spat with Delta Airlines. The rally was particularly beneficial to mega caps with Nvidia and Meta Platforms closing up around 4%. But that's just the tip of the iceberg. Everyone had their eyes on the players, technology leaders like Microsoft and key movers in artificial intelligence. Yet the most surprising twist came not from the tech titans, but from the somewhat overlooked supermicrocomputer, caught in the crossfire of profitability concerns and a 10-for-1 stock split announcement. So what exactly happened? And should you keep investing in these stocks? This is what we will go over in today's video. But first, if you want to keep up with big tech stocks' latest updates and keep up with the stock market's latest news, you can follow our Twitter account. We post multiple times daily about the biggest changes and catalysts in the market, so click the follow button if you don't want to miss the newest market updates. Now, back to today's video.
In real terms.
So there's a combination of factors, and there are seasonal elements, as you say, too, at play here. The future's pointing to an even lower start. I mean, should we be panicking? Should the market be out there sort of hitting the panic button yet?
No, I don't think so. And that's because from a technical perspective, there's a lot of support in terms of moving averages and key technical levels. At the same time, corrections are normal in a bull market. So whether this turns into a bear market or not is still to be seen. But corrections like this are absolutely normal, particularly when you have momentum, which is overdone on the upside, and you have big shifts in kind of macro market and also geopolitical expectations, which hit over the week as well. That leads to market corrections.
Okay, so broadly speaking, so there are three elements to it. There's some bit of profit taking for some markets, right? There's some correction in other markets. But for the likes of Nvidia, right, and the AI chip market, we are well beyond correction and going into a bear market zone with the kind of sell-off that some of these stocks have witnessed, especially the chip stocks. What do you have to say about that?
So I'd say two things. First of all, you can't look at Nvidia like a normal stock just because of its parabolic rise. So if it falls by 20%, it doesn't mean it's in a bear market. It's just a correction in what was a very large run-up. Right, so that's the first thing. The second thing is what we're actually seeing, and you mentioned rotation earlier, is that these mega cap stocks, you know, the Mag 7 or what have you, because they are falling or they led the market up so much, when they fall, they hit the market really in a bad way. And that's causing a lot more volatility than it would be normally. I think what's interesting is to see how the Nikkei, for example, is kind of paralleling some of the moves that we're seeing in US tech. So if you think about the Nikkei, it's getting hit by multiple factors, right? So the first one is the broad sell-off. It's hitting the Nikkei, and the Nikkei has been one of the darlings of asset managers. So there was a bit frothy to begin with, right? The second one is the unwinding of the carry trade. That's causing volatility for the currency, and we know that Japanese companies derive a huge amount of their earnings from abroad. So a stronger yen means lower earnings in terms of repatriated profits. But the other element as well to consider is that the Bank of Japan has become much more hawkish than what people had expected and market expectations. And what that means is that could also see tighter monetary policy, which would impact the domestic growth outlook, which then impacts domestic demand and corporate earnings and profit earnings for Japanese companies.
Imagine walking into a casino where every table has its unique game, a match where technology giants like Nvidia, Meta Platforms, Microsoft, and Supermicro play pivotal roles. Yet, unlike a game of craps, the stakes here are not based on chance but data, innovation, and a hefty dose of market psychology. To fully appreciate the complex dynamics that unfolded, we need to usher in a thesis supported by facts and figures, a journey through colossal winners, strategic lawsuits, and brutal earnings misses. After a painful 3-day losing streak, the market embraced a sigh of relief with a rally that saw the Dow Jones Industrial Average gaining nearly 300 points. For Nvidia and Meta Platforms, the rally wasn't just a breather. It was a roar of approval. Nvidia surged 3.8%, while Meta Platforms climbed 3.9%, signaling renewed investor confidence. What's particularly telling here is the resilience these companies show in a landscape where market corrections are often perceived as the sword of Damocles hanging by a thread over tech valuations. Yet, skeptics like hedge fund Elliott Management were quick to perceive Nvidia's situation as a bubble, marinating in what they deem as overhyped AI promises. If one peels back the layers of Nvidia's current growth trajectory supported by Microsoft's Azure, the numbers tell a compelling tale. AI's long-term earnings potential is especially intriguing. Ankur Crawford, portfolio manager at Alger, underscored how some Azure metrics ballooned from zero to a $6 billion run rate within 7 quarters. Numbers like these prompt a stare down at skeptics who dare to challenge the sustainability of the AI revolution. So, what about other firms like Microsoft and Supermicro? Let's find out. Hello everyone and welcome back to Investocracy.
We're in the red today, giving up some earlier gains. All 3 major indices struggling to recover losses from Monday's sell-off, or at least to back up the gains of yesterday. A few bright spots, though, within tech today. Apple's leading the pack. Amazon and Alphabet are still green as well. You see what those stocks are doing at this moment. My next guest holds all of them. Says now's the time to buy the dip, too. Joining me now at Post 9, Rich Saperstein of Treasury Partners. Good to see you back here. So your phone must have been going crazy on Monday. Can you just give me, we said that you're one of the top 5 advisors, right, ranked by Barron's. So can you just give me an idea of what this week's been like for you?
Well, my first experience with an eye-popping decline like this was back in '87, and we've seen many of them since then. And we've developed a playbook to deal with all this and guard client capital. And it starts with the catalyst. And the catalyst here was really a disproportionate decline in the market relative to the tepid economic data. So lightly caused because we're at 22, 23 times earnings. And really, it's a type of volatility we're going to experience going forward. Now, my phone rings, and it's really about asset allocation. It's about the move we made last year where we allocated to long-term tax-free municipal bonds at 4.5%, and clients wanting to be opportunistic and possibly reallocating back to the stock market.
Were you a buyer on Monday?
No. We think about an old concept called 2 steps and a stumble. And so you have a market, we still fully invested, but you have a market which goes down, there's some decay, there's some issues, there's value, but I'd like to see things settle out first before we start committing more capital.
Do you think mega cap tech, which we're showing on the screen right now, and we said that you own a lot of these names, does that need to, in your words, settle out more?
Yeah, I'd like to see that, but we still like the stocks. I mean, where do you find, let's take Google, Microsoft and Amazon's cloud business. They do $100 billion a year, grew 30% quarter over quarter. Now, a $100 billion business would be a S&P 35 company growing 30% a year. So many investors are underweight large cap tech. And that's really where the opportunity is for investors who do not own enough of these names. They should have an exposure to.
Just when the AI euphoria has you buzzing, enter Microsoft, embroiled in a bitter dispute with Delta Airlines over a bungled software update that led to the cancellation of over 5,000 flights. Microsoft retorted, labeling Delta's technology as archaic and calling for modernization. Delta, on the other hand, wasn't having any of it, countering Microsoft's allegations with a firm rebuff. The saga is a stark reminder that even in a world where technology shapes fortunes, it can just as swiftly become the Achilles heel. This drama may seem insignificant when pitted against the AI revolution. Nonetheless, it underscores the omnipresent fragility of tech infrastructure. As if on cue, the stock market treated this event with near indifference, reinforcing the idea that as long as the big tech stories sell, the discordant notes barely make a dent in investor sentiment. While the big names like Nvidia and Microsoft waged their fair share of battles, spare a moment for Supermicro Computer. Their fourth quarter earnings not only failed to meet Wall Street's estimates, but also left investors wary of its future profitability. Despite a promising first quarter revenue forecast and an ambitious 10-for-1 stock split, the shares fell dramatically by 13%. Just to add salt to the wound, the company's gross margin plummeted to 11.2% from 17% the previous year. The irony here is palpable. As a supplier for Nvidia, Supermicro is expected to ride the AI wave. Yet its financial health tells another story, raising questions on whether the entire ensemble of AI beneficiaries is as robust as purported. For the spectators with a front-row seat to this drama, the ongoing volatility framed by Goldman Sachs' caution about market corrections is almost poetic. Peter Oppenheimer pointed out that the market correction isn't over, insinuating that there's still room for more short-term turbulence before a stable investment ground can be ascertained. So should you invest in these stocks if you haven't already? And if you're a current investor, should you keep dumping your money into these stocks? The answer is so simple. But first, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
When you say investors don't own enough of these names, what kind of investors are we talking about? Because it feels at this point as though everybody owns these names.
Not really, because there's a lot of investors that are underweight large cap tech. And so they might have biotech or other exposures, small cap, mid cap, international. And really, it's very important to understand where there's growth of cash flow and where there's opportunity in the market, and it happens to be rather concentrated right now.
What about valuation for these names? Top of the program today, I read the list of how much valuations have come in as these stocks pulled back from July, double-digit percentage point declines.
No question, values are stretched. Market's price for 15% earnings growth year over year. And that's the reason why we're seeing all this volatility, which should continue throughout the year.
Wait, you mean valuations are still stretched?
Yeah, still.
In these stocks?
Yeah, so we look at the cash flow and the growth of the cash flow, but multiples are stretched in these stocks, and there's still a lot of pockets of opportunity in the market right now.
Okay, so where is that?
Well, we have been adding to two utilities, okay? We started with the thesis on utilities is long-term secular increase in power. And we're underpowered in this country. So we own two names, Nextera and Vistra. We've owned Vistra since 2021. It's a $25 billion company, $4 billion in operating cash flow, $2.2 billion in free cash flow, returning it to shareholders. And keep in mind, our utilities are in two states that have net immigration, population immigration, Florida and Texas.
Wrapping up this eclectic mix of triumphs and tribulations, it's crucial to outline why, despite the noise, tech stocks continue to remain tantalizingly attractive. Nvidia's rally, backed by solid AI-driven forecasts, and Meta Platforms' robust climb, serve as a beacon for resilient market leadership. Even as hedge funds stress the bubble narrative around Nvidia, long-term projections rooted in empirical data provide a compelling counter-argument. As it stands, Nvidia is perched with a market cap that investors eye greedily. Meta Platforms, too, hasn't lost its luster, demonstrating strong potential in reinforcing its role within the metaverse. If we look ahead, analysts project Nvidia to double its AI-related revenue streams, whereas Meta Platforms is expected to solidify its footing in the AR/VR spaces further. Supermicro represents a more intricate puzzle. If the company can stabilize its margins and leverage the AI boom more effectively, it has a fighting chance to turn around from its recent bearish trajectory. Historically, stock splits have had mixed outcomes. However, the 10-for-1 move could attract retail investors and boost liquidity. So, dear viewer, amidst this volatile yet promising landscape, where do you stand? Are you leaning towards the technological zenith symbolized by Nvidia and Microsoft? Or do you find yourself more skeptical, aligning with those who smell overvaluation macabre in every bullish run? We'd love to hear your thoughts, and whether you see these swings as opportunities or pitfalls. Your opinions are valuable as we steer our way through these tumultuous waters. But what do you think about these stock? Is it a buy at the current price? Let us know your thoughts in the comment section. And don't forget to tell us what your valuation for Nvidia is. If you would like to know what big tech companies like Nvidia, Microsoft, and Meta have been up to these past few days, go ahead and click on the next video on your screen. See you there.